So in today's video, we're going to be talking about the commercial property market, the reset that's gone on over the last 18 months, and the opportunity this is going to present to investors who know how to play the game. Now, I did my first commercial conversion, if you like, as an investor back in 2011. And I can tell you right now, I made an absolute hash of it, absolutely ruined it. So it was a tiny little photographic studio that I bought dirt cheap in North Wales, and I went for planning to turn it into 5 flats. Did it all wrong. In the end, got planning for 3 flats, and then did the build out all wrong, and ended up not losing money, but ending up with a building that was about £30,000 to £40,000 less in value than I'd put into it. So I couldn't do anything. I couldn't sell it because I was in negative equity. I had to hold on and cash flow it. Now, luckily, that building cash flowed for the next 10 years. I just sold it last year, actually, and recouped my money and made a very small profit on it. But after that experience, I realized there was so much to learn about property, how to do things properly. And actually, when you watch all these TV programs, like, you know, what was it back in the noughties, sort of Homes Under the Hammer and Location, and, you know, the Sarah Beanie sort of ones, you just think property is a license to print money. You can go and buy anything and it turns into something amazing. It's wrong, right? You can really get it wrong in property if you don't do things properly. So I went and sought advice. I went and tried to find people who had been there, they'd walked the walk, they knew what they were doing, and I learned from them and found out, even though I horribly messed up this commercial property, how powerful commercial property is. And it now is effectively a big cornerstone of my portfolio. And we've seen a really interesting time over the last 18 months. I've seen some people talking about it recently, about the opportunity that the commercial property market sits. So what I wanted to do in this video is I want to talk about that opportunity. I want to sort of pull the cover back a little bit on commercial property. So see what's happened to the market over the last 18 months, see how it completely differs to the residential market, and how we as investors, okay, if we are investors or developers, can take an opportunity from that. So first of all, we are live. If you're on the live and you can see me and hear me, please put a thumbs up and put something in the comments just to make sure the audio is working. I do apologize, team. I know we've had some audio problems over the last couple of weeks. I'm talking to the streaming software company about the feedback and static, and they think it could be a speed issue on one of the leads. However, I've had some great input from other people saying it could be my Whoop band, which I've taken off. So hopefully there's no static or magnets in the Whoop band, so we'll see what's going on. I've also taken echo cancellation off, see what happens. If there's any issues, let me know. I obviously can't hear it, so it's a bit frustrating. And welcome everybody if you're back, or if you're here for the first time, to the live stream where we look at data, we talk about what's going on in the markets to give us better ideas, better decisions that we can make going forward as property investors, okay? So that's what we're going to be talking about today. But before we get on to commercial property, Zoopla has actually spun a little trick on me, and they've put out their November HPI without me realizing it was coming out yesterday. So before I go and talk about commercial property, I just want to run through the November Zoopla HPI, because I think it's got some real interesting stuff. And by the way, if you can, if you are hearing me, put something in the comments. It's always nice to have a chat with people. So let's look at what Zoopla has to say, okay? So we've got as a headline, homes are selling 18,000 below asking price. The number of properties for sale reaches a 6-year high. Super interesting, right? We're going to look at this data because it looks like we are seeing more supply side come onto the market. Now, of course, some people I've already seen spinning this that, look, it just means we're back into a healthy property market. It's fantastic. This is good news. Market's coming back to life. We've always said one of the precursors to a property market, not meltdown, but let's say a continuation or acceleration of the crash, if you like, of the house price correction, is supply side going up, actually. So we think it's the supply side that's been in paralysis, so a lack of supply that's kept it kind of looking resilient, but kept it fairly level. If we're suddenly seeing a supply side going up, and don't forget, last week we looked at Rightmove saying biggest slash in asking prices they've seen for a very long time from Rightmove, and now we're seeing an increase in supply side. Are people suddenly either struggling with affordability or waking up to the fact that interest rates are not just going to start plummeting next year, and so therefore they're like, well, if we're going to sell, we might as well sell now rather than hold on? Or are we on the other end of the spectrum, and are we seeing some confidence back in the market with swap rates down, sentiment turning? Is there some mainstream media-led sentiment going on that's actually causing the perception for the majority of people to go, oh, actually, we're going to be good in 2024. Let's get back to business. So we want to make some sort of assessments of that. So let's have a look at this data. By the way, the other thing I want to really stress on this, I'm just going to go straight down to this graph, right? One of the reasons that I do this channel and do these shows is to cut through everybody's agenda, and everybody has an agenda, and I'm here looking at objective data and trying to work out what we can from objective data. And very often, how the objective data is presented to us gives us an idea of the agenda of the person who is putting it out. And by the way, I really like Zoopla. I really like Richard, who always publishes this, and I love the HPI. I love the data that comes out of it. It's less of an HPI, more of a forward projecting model. But I just want to show you this, right? So we can see this this chart they put on every single month. Demand, basically, it's by demand, number of sales, flow of new supply, and stock of home for sales, right? If anybody has noticed this, let me know. For the first time ever, there's only one set of bar charts on this, and that is the purple versus 2022. And look, buyer demand is 10% up. Number of sales agreed is 15% up. Stock of homes for sale, 34% up. It's like the property market has come back to life. We've suddenly got this massive surge in buyer demand. We're suddenly seeing this massive surge of sales agreed. Let's just take a time out quickly, right, and look at what this is relating to. This is versus 2022, okay? So this is percentage change 4 weeks to 20th of November 23 compared to the same period in 22. Let's go back a year. Where are we this time last year? We are in the hangover of the Truss Kwarteng mini budget, where we saw the biggest monthly falls in house prices that we've probably seen since the peak, right? It was October, November last year. So we are directly comparing here with that period last year. So all this is showing is we've got 10% more buyer demand now than immediately after the mini budget last year. Okay, 15% more sales agreed than immediately after the mini budget last year, where I know so many house sales fell through because mine was one of them. Let's just compare this to October's. Okay, October we've got versus 2022 and versus the 5-year average. And you can see buyer demand versus 22 is 17% down last month, this month 10% up. We haven't just suddenly found 27% swing here. You know, this for me is selective data, and the fact they've taken the black line off, and the black line is versus the 5-year rolling average, which they've shown every single month since I started doing this channel. They've taken it off, and that shows the agenda that they're trying to put out, right? Ultimately, Zoopla needs to have houses or agents listing with them, houses listing with them to make money. Anything positive they can put out, they're going to be putting out. This is why we have to be careful and understand what's going on, okay? So anyway, that's what is interesting is the stock of homes for sale is 34% up. So we can see something that is floating through, you know, month by month is that stock of homes for sale going up. So what else are we seeing? Let's just scroll down here. Actually, we see this sort of dip in sales agreed at the same time every year anyway. This as we come into Christmas, unsurprisingly, in Christmas we see those dips. So we're not seeing an awful lot from that. We're seeing house prices fall pretty much across the board now in negative territory year on year. We have some pockets in the UK that are still positive year on year according to this, and they're at the cheaper end of the market. Again, there seems to be more resilience in the cheaper end of the market, as the biggest drops are coming from higher end of the market, larger properties. No surprise there. This is just reinforcing everything we're talking about. This for me is interesting. Highest number of homes for sale in 6 years. Okay, so the narrative says this: a chronic scarcity of residential property for sale during the pandemic, particularly for 3+ bedroom homes, was a key driver of house price growth between 2020 and 2022. We are now seeing completely the opposite, with the highest number of homes for sale per estate agent for 6 years. And actually that has come up quite consistently since the since the peak of the market last year. So what's this saying? For me, we're seeing more supply. I think this is going to put more downward pressure on house prices personally over the coming year. We're seeing them talk about largest discounts to asking prices for more than 5 years. This is very much reflecting what Rightmove has said. So we've got house prices being slashed more than they have been, more supply than we've seen for 6 years. It feels like it's softening. I've got to be honest. Maybe it's thawing, but that thaw is going to soften it and come down. Would be where I look at this data. So that's very quickly what I wanted to go through with Zoopla. Anybody else got any thoughts on that? Just if you're new to the channel, what I'm going to do is I want to go through all the slides, go through the content, and I'll come back and answer questions afterwards. I know somebody's asking what a whoop band is. I'll tell you what a whoop band is later on. It's all biodynamics and biotracking and data, and I love data and all that sort of stuff. Right, before we go and talk about commercial property, it's that time where I ask you the one favor I ask you, only ever ask you on this channel, that is to help me grow it for the reason I'm about to tell you with Past Me. I'm going to pass you over to Past Me for 30 seconds time, and then we'll talk about commercial property. Those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income-producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Cool, please do that. Please hit subscribe now if you're not subscribed already. It would mean an awful lot to me. And look, just to give sort of zone our eyes in today. So today is going to be a little bit different. This evening's live. I'm going to do a bit more sort of big picture, look at markets, look at property types, look at strategies, as well as sort of data analysis. It's not just a data number crunching exercise this evening. This is something I want to start weaving more into the show for those who want to learn a bit about sort of investing property, developing property as we go into 2024. So let's talk about commercial. Now, this has been triggered by actually this article, which I saw another channel talk about this week. And they made it out like this article had just come out, and they were saying they were quite surprised why it's just come out. Right, this article came out in summer this year, and it's a report by Goldman Sachs about the state of the commercial property market, talking about the big reset the commercial property has had and where the opportunity is. Okay, now let's go over to the iPad. So this is now a slightly old graph. I can't find a sort of neater, more up-to-date graph. I'll keep looking for one. All of the talk that we've had, or pretty much all of the YouTube sphere, all of the social sphere, most of the mainstream media talks about residential. Residential is the thing that everybody is sort of obsessed with, mainly because everybody has a home, right? Or lives in a place, whether you're renting, you get affected by it, or if you're owning, or if you're moving, or if you're investing. So commercial is a much smaller section, and the dynamics, the fluid dynamics, if you like, the market dynamics are completely different in commercial to residential. Now, the residential market's been fairly neutral. We are year on year down now, but fairly resilient in nominal terms, in terms of price growth or decline. Whereas the commercial market, the bottom fell out of it last year. Okay, so you can see from this graph here, post-COVID, and I want to just make sure I got that right. So all property is the blue. So kind of just look at the blue line. The red line is offices, which are a little bit more affected, but I just want to focus on the blue line. Just like residential, maybe even more so actually, post-pandemic, we had a big shoot up, but then you can see how that bubble popped very quickly. And this is Q1 23, by the way. No, sorry, this is taken to Q4 22. So we're almost a full year on from this now. So a year ago, the sort of commercial property benchmark, if you like, was below the the sort of trough at the pandemic level, and all the way back to levels we were 2014, 2015. So still recovering from 2008. So you can see how sharp a decline that is. Now you're probably wondering, why does that happen so quickly compared to residential? Well, here's the pressure factors that came on commercial property. Number one, commercial property is valued on a yield basis. And I'm going to walk you through the methodology for that in a second. It's very much like how you would value a bond, to be honest, the sort of dynamics between valuing it. We talked about bonds a few weeks ago. So the valuation structure is extremely different for commercial. What we also see is a lot of people's mortgages, I say people, a lot of commercial, we're talking about big sort of, institutional investors, pension funds, family offices who own huge portfolios of commercial property. Maybe they own REITs, which are real estate investment trusts. A lot of the commercial lending is done on variable rate lending rather than fixed rates. So something that's really cushioned the residential market is is people's fixed rate mortgages, 2 to 5 year fixes. We talk so often about 1.6 million coming off in 2024. So there's still so many people on cheap fixed rate debt. Commercial is very different. That comes up more quickly, so people are having to refinance onto higher mortgages. That, of course, puts pressure on. And then we had this structural change in the commercial property market post-COVID, actually. So a lot of habits changed, workforce changed, and this especially hit offices. So these big sort of, big floors worth of office space are now sitting empty as people work from home or hybrid working. So that's put a lot of pressure. The one I want to talk about really to understand here is yields, because this will never change. Whereas things like loan expiries, COVID changing the structure of the market a little bit are kind of one-offs. But I want to talk about or simplify the valuation methodology for commercial, because I find, like everything, I don't know if you watched The Big Short, or if anybody's seen the film The Big Short, fantastic film, Ryan Gosling, and it's Ryan Gosling, isn't it? Yes, and some various other people talking about the financial crisis of 2008. And there's a theme running through it about how bankers and sort of financial people make up all these confusing long terminologies, and we could talk about cap rates, capitalization rates, all that sort of stuff, to basically make themselves feel clever and feel happy about themselves. That might be a bit unfair on some of these people, by the way, but it is true. The industry creates lots of complexity with things that are actually very simple. So let's talk about yield. All yield is a percentage return on something, okay? So generally in property, we'll work out yield, and there's different types of yield. I'm not going to go through them all here. Let's just talk about gross yield. Would be the income that comes from a property over the value of it. So let's say you've got a property that's doing £10,000 a year and it's worth 100 grand. Okay, your yield is 10,000 divided by 100,000, which is 10%, and it's expressed as a percentage, right? So your yield is a percentage. So that's how we calculate yield. Now, for residential property, a lot of people talk about what yields do you get, what gross yield do you get, what net yield do you get, right? And you'll go and buy a property for 200 grand, and therefore you know what the value is, you know what the rent roll comes through, and therefore you can work out the yield on that residential property. In commercial property, it works the other way around. So if we rearrange the same formula with some very basic sort of 8-year-old maths, we can just swap some of these elements around, and all of a sudden we've got value equals income over yield. So with commercial property, we work out the value of a property based on the income it produces and the yield that the investor or the owner is looking to achieve. Now, that might be a bit of a head sort of blow moment, because it's like, wait a minute, that means the valuation is going to change depending on who wants to buy it and what yield they're looking for. Correct, that's exactly what happens. So in the era of very cheap interest rates, when we've been at 0.1% for however many years and 0.25 or 0.5 for however many years above that, investors couldn't get good returns, good yields on things like bonds. We talked about bonds quite a lot. You're probably getting a negative real-time interest rate, but let's just say nominal, you might be getting 1% on a bond, something like that. So therefore, an investor will go, right, I've got my fixed, very, very risk-free bond, but it's giving me very little. So I'm going to put some money into something higher risk, some commercial property. And because I get 1% on a bond, I might go and look at 5% return on commercial property. So they go, right, I'll go and buy property that gives me 5% return, right? And it's all about risk. Now, what happens if the interest rates go up? The bond yields go up, which is what we've been talking about. If the bond yields go up, let's say the bond yields go up from 1 to 6%, which, by the way, is pretty much what they've done. If you're investing in commercial property and you're getting a 5% yield, but you can just stick it in a completely risk-free bond for 6%, why would you put your money into that commercial property anymore? You wouldn't. You need a higher yield to justify having that or buying that property, right? So you might now look for 10%, 12% yield. And because we've got this formula where the yield is on the bottom, if somebody's looking for a bigger yield, it means it's an inverse relationship to the value, and so the values go down. So in a nutshell, interest rates go up, right? Commercial property values go down. Let's just think about that very, very, very simplistically. So what's been happening over the last year and a half? Interest rates have been shooting up, but not just going up slowly. They've gone up aggressively, quickly, and consistently, and that's put a shock through the valuation of commercial property. So when banks come to refinance, they're refinancing, with their clients who own all these commercial property. They're like, wait a minute, this property is worth half of what it was worth a year and a half ago. We're not going to lend anymore, or we're going to pull that product. And it really starts to affect the commercial property because people have got to sell it, right? And when we're talking about people, again, a lot of the time we're talking about institutions. So that's a very quick lesson on how commercial property is valued. So interest rates gone up, values go down. Now we're probably at the top, maybe the absolute top, but maybe we've got another little bit to go depending on what happens with inflation in the tightening cycle. But for all intents and purposes, we're probably there at the top on what they're calling Table Mountain now at this point. So you'd think we're bottoming in terms of value of the commercial property world. Does that mean This is now starting to get to a point where we're looking at an entry gate, right, into commercial property. Is this where the opportunity is? Because at some point everything bottoms and reverses. So right now, okay, with, I say reversal factors, I've got supply, cost to build, and yields increasing. Yields aren't increasing at the moment, interest rates are where they are. But let's say those interest rates come down, okay, that means we're going to see that just naturally property prices, commercial property prices go up again. The other thing is there's not been a lot of building of commercial property because of inflation. It's been so much more expensive to build and the values have gone down. Nobody's been building commercial property, so there's a supply-demand imbalance. In certain sectors, office not being one of them because we talked about the structural changes. But for example, look at industrial, light industrial storage, massive shortage in those sort of areas. Okay, so at some point we're going to start to see a reversal of this. And as I would say a property entrepreneur, as a contrarian investor, that's something that really excites me. Okay, so what I want to do for the next 5 minutes or so is kind of talk through as I would say a tiny micro investor, not a real estate investment trust, not a family office, not a pension fund. What can we do as the everyday person who's investing in money compared to residential? Right, because there's lots of question marks over residential at the moment. What's going to happen to the market? Is it going to go down 20, 30%? What's happening with all the regulation, tenant reform bills, or renters reform bill as it's called, tax changes, all of these things that's making it so much more difficult for buy-to-let investment to work. Certainly as retail buy-to-let investment, where somebody just goes and buys a property with a mortgage and a deposit and sticks a tenant in, okay? So where is the opportunity for people who are learning and trying to get the skill set to do it? So let's go and analyze where the opportunity might be. So first of all, let's just talk about straight commercial property. So you buy a property, you buy a commercial property, and you keep it as a commercial property. So you rent it out to a commercial tenant. Now, why would you do this? Here's the reasons that I love commercial. Number one, you buy a commercial property. If it's empty, right, because there's no income coming from it, naturally it's going to be worth less because it's not residential, it's not bricks and mortar. You can have a commercial valuation, so you can buy it cheap in the first place. It could be completely trashed. All you have to do as a commercial landlord is probably rip it out and white box it, which is what we've just been doing in one in Chester. And by white boxing, I mean probably just plating it with plasterboard, not even plastering it, having utility connections, probably a toilet, something like that, and that's it. Then a tenant comes in and spends tens, if not hundreds of thousands of pounds fitting out your white box effectively. So that's the first thing. Second thing is you're going to get much longer term tenants in commercial. Let's look at some of the detail of that renters reform bill. There is now no longer a minimum AST length. Effectively, a tenant comes in on a rolling AST from day one, so a 2-month rolling contract. So at any point, they can just go, boom, we're off with 2 months notice. They could, day one, hand their notice in and leave 2 months later. There's not a lot of security of tenure there for a residential investor. With tenants, you're very much wrapped up in leases, which can be 5, 10, 15, 20, 30 years long. And these leases are very valuable, right? Because they're effectively the longer and the stronger the lease or the covenant on it, the more valuable that is for lending or valuing the property. Again, you look at risk factor, look at yields, all of that sort of stuff, okay? They're going to be on fully FRI, which is fully repairing and insuring leases. So they come in, some damage happens, they fix it, they insure it. Residential, you're doing all that yourself. Another great thing, another strategy that I love, by the way, is adding value to commercial property through something called lease re-engineering, okay? This is, again, if I just go back to, here, value equals income over yield, it should follow that to increase the value or decrease the value of a commercial property, if you change the income in it, it's going to materially affect the value, right? So if you buy something and double in income, the value theoretically, assuming the yield stays the same, should double. So you can come in and buy something either empty or in a very low or poorly performing lease and re-engineer that lease, and immediately you've added value to the property, which you can then recycle out. You've added value, added equity, take your money out, get a massive return on it, okay? So that's another reason. Reason number 4 for why commercial is cool is landlord's rights. In residential, all the rights are generally with a tenant. And by the way, as a tenant myself, I'm a tenant here, I thoroughly enjoy having rights. And I think for residential tenants, you should have rights. It's your home. Landlord shouldn't be able to remove you for no reason. If you're not paying the rent or you're smashing it up or you're annoying the neighbours, I think that's a different matter. But if you're looking after your home and you're established, you should have rights. Commercial's very different. Commercial's a business. So if that all goes wrong, or if you're not paying the rent, or if the landlord just wants their unit back, they've got a lot more rights, depending on the leases, of course. So it's much quicker to remove a commercial tenant if they go into arrears. For example, you can get rid of them very, very quickly, probably within a month. You also have these things called dilapidation. So at the end of a lease, when a tenant moves out, at the beginning, you'll have had a schedule of condition, and then you'll have dilapidations, which means the tenant's got to put it back exactly to how they took it. Now, we could go to the nth degree on this, and some landlords do this, which can be a bit harsh, but again, all the rights are in your favour. The other thing I love about commercial is that you've got many more creative purchase strategies, because you're very often buying off business owners or institutions who understand creative purchase strategies, things like buying on options, leases with options to purchase, deferred payments, all of these sort of things, which mean you can get into buying these things with a lot less money, which is really cool. And then finally, you've got a lot more tax incentives. I did a video on this a few months ago. Follow the breadcrumbs. All of the tax incentives for residential are being taken away. Section 24, extra stamp duty, completely the opposite in commercial. You've got capital allowances, you've got structures and buildings allowance, you've got a much lower regime for stamp duty. So the list goes on. So you've got many tax incentives that make it worthwhile with commercial, which means you end up keeping a lot more than you save. Of course, there's some risks, and I've had a lot of comments on the videos, and I've been talking about commercial recently, saying, "Oh, it seems really risky, with economy on the brink. If you buy commercial, are you ever going to get a tenant?" Of course, it depends where you buy. You've got to buy in the right area to attract the right tenant. So it can take a lot longer to find a tenant. It is linked to the economy, but right now, look at where the demand is. Demand is industrial, light industrial, storage. I actually quite like high street if you're buying the right units. I'll tell you what sort of units to buy in the high street, because there's always going to be demand there. Whether or not their tenants can stay in there for 15 years is another matter, but there's always going to be demand. The other thing is it can cost a bit more to carry a commercial unit if it's vacant. Business rates potentially, depending on the size of it, all of these sort of things. But on the balance, there's so many pros on commercial. So here's my recommendation to you. If you're looking to get into commercial, I would recommend smaller commercial units of £1,000 to £1,500 square foot. Why? Because you can do that with more flexible leases to attract tenants. You're going to attract a bigger pool of tenants rather than, things that are really struggling are massive office buildings right now. They're trying to attract big blue chip tenants to take big office buildings when all the staff are working from home. Small little units, people can come on flexible terms, much more incentive for them to come and take your unit. The other thing is it's going to put them below small business rate relief. So it's going to be much more affordable for a smaller company to come in and take one of these units because they get an exemption from business rates. So flexible leases, if it's going to be high street, so retail, restaurant, cafe, got to be a good location. Clearly, you don't want to be buying stuff in, run down high streets that are fully boarded off. You're never going to fill that. But there's lots of great locations out there. The one I'm going to show you in a second is in the middle of Chester. So there's warehouse, industrial units, and mixed use. So my personal favourite, let me come back on that. My personal favourite is mixed use buildings, which are, as it says, a combination of commercial, generally on the ground floor, and flats above. Or you could get commercial with office space above and convert that office into residential. We'll talk about that in a sec. Okay. So mixed use is really cool because if you have any commercial element for a lot of the tax things, that especially sort of stamp duty, multiple dwellings relief, that's going to filter through at the commercial stamp duty rate. So here's the one that I bought earlier this year. So this is in the middle of Chester. Let me just zoom in a little bit more. It's this building here, and as you can see, we've got flats above, so it's 3 stories. We've actually got 4 flats in there, and then we've got a commercial unit down here. Now, this commercial unit had been empty for 5 years. It hadn't been white boxed. It was in a terrible state. It hadn't been presented well. The landlord didn't really know what he was doing, and it sat there sort of empty. Now, because it's empty, this means that the building is worth a lot less. And don't forget when we talked about the valuations, the prices of commercial dropping down. This is really weighing this building down. Not to mention that the flats up here have got tenants who've been there since the 90s, who the landlord and the tenants thought they were on protected tenancies on very low AST. So actually a similar thing. A building like this generally is going to be valued on a commercial basis anyway. So the whole thing is valued at a depressed valuation. Now, this originally hit the market, as you can see, at £450,000. Okay, didn't sell at 450. Went into auction at offers over 400, with the landlord saying I'm not going to sell it for under 420. I bought it this year for 345,000. So 345. To white box this thing down here has cost us about 10,000, maybe about 15,000 total to white box it. Renegotiated the ASTs on the flats, and those 3 out of the 4 flats were full. This one up here, we've been refurbing it. We're putting it on as a short-term let. Now we finished white boxing this, just to give you an idea about how long it takes. We finished white boxing this in September, so we're now November, so we're 2 months in, and we've just got heads of terms that came through last week, a couple of weeks ago. Sorry, I'm just trying to get it so you can see the whole thing. Oh, sorry, I can't drag that down enough. If you can see there, it's 15-year lease, and we've got a rent of 24,000 a year, so £2,000 a month. Heads agreed on that. Actually, we've just nudged that up to 25 because we've got another person, another interested party. So there's a bit of sort of discussion between the two. You can see what we've had to do is we've had to give the first 3 months of the lease as rent-free, which you can see here, and then the second 3 months at half price, so we get full rent after 6 months, and that's because they're probably going to spend 70 to 100,000 pounds fitting this place out. They'll do it all themselves, okay? And if for whatever reason they do go and they go out of business very quickly, all of that will likely stay there, depending on what happens in that thing, okay? So that's an example of what we can do with commercial and how we can add massive value to this. And by the way, just to give you an idea of where we are on valuation of this, we've now got 24k for a year for the commercial. Let's say, so the market rent for a 1-bed flat is probably 700. We've got the 3 flats on 550 because I didn't want to evict the elderly gentleman who lived there, so that's 1,500, 1,650. Let's just say 2,500 a month because we're going to put the other one on short term. That 2,500 a month, 25 is 30 grand a year for the flats, which means we're 54 a year in terms of rent roll. If we go on a 10% yield on that, we would be valued at 540k on the building. We bought it at 345 and we're going to be all in, including purchase costs, for under 400. So a 10% yield, we've added 150,000 pounds worth of forced appreciation on that building in what most people would consider a dropping property market. So, okay, this is why I like commercial and what we can do with commercial. All right, hopefully that was interesting, kind of run through that, by the way. So that's commercial. Now, the next reason or the next thing we can do with commercial is go commercial to residential. So this is conversion. You might have heard the term commercial conversion, where we go and buy the commercial and then we turn it into residential. So we're not going to keep it as commercial. So this obviously de-risks it. We can buy underutilized, depressed commercial and then change the use of it. So why would we do this? Again, we can go creative with the purchase structures for exactly the same reason as buying commercial. We can leverage this thing called permitted development, which means we don't have to go through the full planning system. There are, of course, some caveats to permitted development, parking being one of them, some environmental aspects being another of them. But generally, we can fast track the system, and as long as these boxes are ticked, we should be able to turn commercial into residential. I'm not going to go through how we do it. I'm not going to go through all the classes, all that sort of stuff on this training. That's sort of too much detail for this training. But just permitted development takes commercial to residential. Again, we've got lots of great tax incentives we talked about, but my favorite one here is called value arbitrage, right? This is my favorite strategy in property. And when I say value arbitrage, I mean we buy at a cheap price per square foot, we convert to a much higher price per square foot. We're taking the same building, we're increasing the value of that price per square foot by converting it from commercial to residential. Of course, we're going to have a cost to do that. So if we know the cost, in fact, let's just come off here. If we know the cost that we're buying at, if we know the cost that it will do to convert it, and we know what it's going to be worth at the end, then effectively we add those two together and we just have a margin. So let's say we can buy for £100 a square foot. Let's say we can convert for £100 a square foot. So we're in for £200 a square foot. And let's say it's then as residential worth £300 a square foot. We've made £100 a square foot. Every square foot in that place has added £100 of value to that property. Okay, pretty cool. How can we do that really quickly? I want to give you a couple of resources that you can use for this if you are sort of tech inclined. So I use heavily PropTech, which is technology with property or property technology. The two I use are property data and property filter. So I'm going to show you how easy this is, right? I'm just going to do something random. I'm just going to pick an area. Let's say, let's research some local data in Let's go Portsmouth, because that's not too far from where I live, and it's probably got a decent amount of property in it. Not Winchester where I am, which has nothing. I'm just going to expand the, in fact, let's go to a circle and go 3 miles. Perfect. And let's just generate some data. And, oh, it's a large area. That's fine. What it's going to do is it's going to tell us what the values are in this area. Okay. And what we're then going to do is see what there is we can arbitrage. So straight away, we are getting asking prices. I want sold prices. Asking prices we know are probably going to be inflated, even though they're coming down. I want to see sold prices, and I want to see them by square foot. Okay, so this snapshot here shows us in Portsmouth everything that's sold in this area within the however long time frame. I think it's 5 years, something like that, or probably more. I think we can. Sorry, 18 months. So we actually want to refine that down for the last year. Anyway, it's giving us an average of £294 a square foot here. We can see the spread, which is great. So we can actually go and click on all of these and see what property it was that sold. So averages are great, but we want to refine a bit more. So if I was going to make some nice flats, I'll probably be looking on this higher end. We've got a big collection here, you know, kind of up to about £400 a square foot. So I know that if I'm creating some good quality property in Portsmouth, I'm probably going to be able to get £300 to £400 a square foot for selling it. So what I'd now do, okay, is I'll go over to property filter, my second piece of prop tech that I use. Oh, that's created some balloons in there. Neil says, no, you can only use commercial property for the use it's permitted for. No, Neil, that's incorrect. There's plenty of permitted developments we can do. Or you speaking to somebody else? Are you speaking to Re Green? Sorry, I think you're having a different conversation in there. Right, doesn't matter. We'll get to the questions in a little bit. So let's go for creating a new lead generator in here. Or did I create one earlier for this? Let's go lead generator. Let's go add a new lead generator. Just do it from scratch. Let's search for not Chester, which is my usual stomping ground. Don't want to reveal all the great deals in Chester. Let's have a look at Portsmouth. And I'll just select all of these postcode areas kind of around the centre of Portsmouth just to see what there is. Let's hit next. And then the great thing about PropTech is it just does all the heavy lifting for you. So let's say I want to do commercial to resi. So I'm going to hit my strategy of commercial to resi, hit next on this. Let's just call it test. Hit that save, and it's going to find me everything here that I'm looking for, commercial to resi. There's my test. If I go into it and have a look at the leads, it's going to show me everything that it believes in that search area fits the criteria for a commercial to residential filter. And it's also going to show me things, it's going to filter it in terms of qualification, if you like, on how good a lead it is in terms of getting a good purchase here. So show me properties that are back and reduced, properties that are back on the market, properties that are reduced on the market, things that have been on for more than 90 days. There's a whole wealth of data here. So of course, back and reduced is the best. And what's the first thing we've got here is this. Look at this. Let's have a look at this one. This looks like a fairly substantial office building. Oh yeah, look at that. So this might be a bit challenging for a first deal to go through and turn into flats, okay? And because of the size of it, it's not going to be in permitted development anyway. So take this with a pinch of salt. But because we're live and we haven't got enough time to go through all of it, I just want to make the point here, because if I go back on that, it shows me what the price actually is. Shows slightly frustrating price per square meter. To give a sort of 80-20 overview, I generally just divide it by 10 to give a price per square foot. It's not exact, but you can see on this, if I zoom in on that, it's £776 a square meter, which is about, let's just call it £80 a square foot. Okay, so this commercial building is being sold for £80 a square foot. It's been reduced by 17%. It's been on the market for 523 days. It's obviously come off the market, gone back on the market. Okay, so I know I can buy that for £80 a square foot, and I know that we've got some residential that I can go £300 to £400 a square foot. If I can convert that for £100, £120 a square foot, we're all in for £200 a square foot. We are making big profit there from a commercial to residential. Sorry, I'm just looking at some of the chat going on. Commercial to residential development. So I hope that makes sense in terms of how you can really quickly work these things out and see what sort of properties are going to work for you in your area, what areas are working. By the way, I've just kind of scratched the surface here with these platforms, what we can do, how easy it is. If you want to use these platforms, take them for a test drive. We've got a couple of links here, which you can, for property data, it's propertydata.co.uk/a/RS. These are all in the description to the video, by the way, and I'll link them into the pinned comment. And if you want to go property filter, that's actually the wrong link, so I'm not going to do that. That's an old link. This will give you a test drive. Both of those links, when I pin them in the comments and they are in the description, will give you a 2-week free test drive of these platforms, which you can have a go with. Okay, so that is commercial to residential and value arbitrage. Love it. An example, this is one from my portfolio. This is a nice big building in the Northwest called the Phoenix Club. Yes, it is called the Phoenix Club, which we took from a working man's club and turned it into effectively 2 retail units on the ground floor. You can't really see it. It stretches back all the way like that. So there's actually split there. This is retail 1, which we actually sold to Martin McCall's, but they then turned into Morrison's. And there's another one here. And then on the top, we've got 13 flats. So again, it's mixed use. What we actually did was we sold off the 2 retail units at the time, because we bought the building for 186k. And this unit here, which we white boxed, so not the second one, not that one there, just this one here, we sold that for 250k. And we spent about 10 grand white boxing it, so we just stripped it. We actually put a floor in and a DDA compliant toilet, and we sold it for 250,000. So effectively, we got the building, the rest of the building, for free by doing that. And that's a nice little strategy you can use. Okay, so that's commercial to resident. Then finally, before we go to questions, I hope this is useful, by the way. Somebody give me a thumbs up if you're finding this useful. We've got niche commercial types, and for me, that's things like super HMO, so massive HMOs, apart hotels. You see a lot of sort of ex guest houses, ex hotels, B&Bs. That's all commercial. Again, I love this because it's very niche. So you haven't got a lot of people out there looking for these sort of things. This is the King's Hotel, which I bought just after the first lockdown. So completed on this November 2020, just before we went into the second lockdown. Big old 14 beds B&B. And then over here on that level, you've got a 2-bedroom owner's accommodation flat. It's beautiful. They were trying to sell this pre-COVID for 950,000 pre-COVID, okay? COVID came, it destroyed their business model because it's a B&B. So at the time when we were in the first lockdown, and we have some sourcing strategies that find this sort of thing, the motivation was super high from this vendor to exit because they didn't know if they're ever going to be able to trade as a B&B again. So they hadn't sold it for 950 plus before COVID. COVID came, they were there by themselves, living in there. We bought it for 765. Okay, so 950 down to 765 because they just wanted to get out at that point. So effectively, we bought this big lump in Chester, city centre Chester, for 765. And again, this is because they had no income. So there is an inherent value in the bricks and mortars, but it's commercial, empty, 14-bed guest house with no trade going on, and they didn't have any trade. You know, they're actually running it very low anyway beforehand, so it went to almost nothing in terms of any goodwill value there. So you can see here when we actually got the mortgage on it, this is what the valuation said. So that was the valuation on us. Now, if anybody does any sort of financing with commercials, this is through Lloyd's. When you get it, when you buy it with a mortgage, they're not going to come and say, oh, it's valued at 1.5 million or whatever. They're going to say it's valued at what you're buying it for, as long as they don't think you're overpaying. So in this case, we bought it for 765. So they're saying the market value is 765, which equates to £148 a square foot, or 47,500 per ensuite room in the B&B. Okay, so that's the value we bought it at, and then there's comparables here on the same road. Now, actually, these are residential, not B&B, but you can see we've got comparables at 235, 294 and 285. So the average of that is probably about 270, 280. I know in Chester, residential, decent residential is probably 250 to 300. And we bought this thing for £148 a square foot. Massive discount because it's empty, commercial, not producing any income, okay? So that's what, again, when you compare it to residential. They also compared it to other B&Bs. And you can see that this one was valued as comparable at 56,000 a bedroom. These were 1-bed studios at 137.5 a studio. There's another one there, 212 a square foot, but another one at 85,000 a bedroom. So you can see when you compare that to our 47 and a half a bedroom, we've got a significant discount on it. So another fantastic way of buying below market value or distressed property and then being able to arbitrage that to a different valuation without really doing any work at all. Whew, there we go. There's a rundown of commercial and where I believe the opportunity is, which, by the way, I think is where the opportunity is for the next couple of years. It's what I teach my clients on the Property Cashflow Accelerator. So summary of all of this, right? We're approaching entry points for the commercial market, I believe. We're probably bottoming out. For me, prime strategy here is value arbitrage from residential or to residential with committed development. I think it's a core opportunity for a lot of investors and developers as we go into 24, 25. I say investors rather than developers because I wouldn't be looking at doing this and selling them on because that's more risky, right? Especially in a flat or a diving market. But if you're holding for cash flow, remember we're forcing appreciation, recycling cash, and then getting a very high cash flow from it. You can imagine something like that. 2-bed flat on Airbnb, 14 ensuite rooms is creating a lot of cash flow every month. This is 13 flats. We actually have that leased to a housing association. It's about $5.5 grand every month comes in. This one again, we've got multiple units. All of these are high density multiple units with a lot of cash flow that's servicing and a lot more the debt even at sort of 8% interest rates, which is what the banks are offering at the moment. Other things are commercial. Landlords have much better rights on commercial itself, much better tax regime. We can offset so much of our profits against capital allowances, structures, buildings allowance, other things like that. But if you're going to get into commercial, you've got to understand the areas you're buying. You've got to understand the road you're buying in. You've got to understand the models that you're doing. And that's why it's not a newbie for the faint-hearted thing. You need to follow those breadcrumbs, like I spoke about at the beginning. You need to find somebody who knows what they're doing and really get your hand held through that process. So that's commercial for me. Hope that was of use. Right, I should have some water after that. I feel a bit parched. Let's see what some of the comments were. And again, please give me a thumbs up if that was useful. I know it's a little bit of a different probably audience and vibe this evening going through something like that, rather than just market analysis, but hopefully it was interesting for people to go through a bit more sort of strategy, high level concept training. Sam says, do you think interest rate cuts, let me put this on the broadcast, do you think interest rate cuts through 2024 will increase house prices through demand, even if rates don't come down that much? Sam, I honestly can't see house prices going up in 2024. I think, markets clearly disagree with Bank of England about where interest rates will go. I've always said that I think interest rates will start coming down summer, maybe next year. We know the lag in the system is so great. I would predict that the end of 2024 would be a decent amount less than the end of 2023 is my thoughts on where we're going to be with that. Don't take that as gospel. We could see completely the other. I feel the whole market and looking at that Zoopla data, I interpret that as the market softening. More supply coming on means more people are going, actually, there's no point waiting around. We just need to move. And maybe they're going, actually, we need to move now because 2024 is still going to go down in price. So let's try and get it done now and get moved. I could be completely wrong. It could be loads of confidence coming back in and confidence gets the market moving again and people start paying. But maths and logic don't agree with that rationale. A lot of people will say, look, the housing market, is getting life breathed back into it. And people still have affordability issues. Okay. We've still got, when we look at those slides, we look at the UK's aggregate DSR, debt service ratio for mortgage costs going up and up for the next 2-3 years. 1.6 million people next year coming off cheap fixed rate mortgages. That's going to hit affordability. Yes, we've got some, wage growth still, but how long will that last? And if the economy tips and we go into recession, there ain't going to be any house price growth. It's going to go down quite a lot, I'd suggest. So we have, as humans, I think a lot of us have a natural bias, a natural tendency for optimism, and look, kind of almost. I talked about cognitive bias a couple of days ago, and we have this ability to paint this rosy picture. I mean, some of us have a natural optimistic bias, some of us have a natural pessimistic bias. I try and sit in the middle now, Because I find if you're too optimistic, you can really screw things up. If you're too pessimistic, you can never take advantage of the opportunities. If you're in the middle and you look at both and be balanced with it, then I think that's the best way to be, which is why my personal strategy right now is I wouldn't be looking at buying anything to add value and sell on. I wouldn't be trying to flip properties. I wouldn't be trying to develop properties right now. I am accumulating. We're just having our second deal property purchase of the year going through legals at the moment, which will be about £1.4 million worth of property we bought this year, all of which I think is aggressively below market value and cash flows at 8% interest rates. So I'm very happy with that. Would I be looking to flip them on? No. In a year's time, that might be completely different. And at some point in 2024, right, we're going to be coming to the bottom of that market, and then we'll probably start to see the opportunists come in a lot more. You might be seeing people start to land bank, ready for the market to turn around again, or at least level off. I don't think we'll just see house prices and average on the HPIs be going up in 2024, but I could be wrong. I don't know if that answers the question. Cool. What else we got? Brody, right on cue after all those Paul Smith commercial property investment ads. Yeah, sorry about that, Brody. I'm not going to say anything else on that matter. Neil, I noticed that min wages and doctors' wages are going up 20%. Will this not be inflationary? No doubt the Conservatives will look to leave some more traps in the next government. Yeah, so I've not... I don't know if we're looking at the data set that came out recently, which included the double bonuses they got, the one-off payment. Sorry, I have no idea what's going on with this. I think it's my software. I do stuff and it makes like balloons come, and I need to work out to turn it off. I think that's what we're talking about, is that double payout they had that was agreed, and that's gone into the data, and it basically a huge spike of wage growth, nominal wage growth in there. So if will it be inflationary? Potentially. Is it something that was going to continue? I doubt it. Right? It was 2 one-off payments, if that it can even happen. So we'll have to just keep an eye on that. Green, Rob, isn't the value also affected by payments they have to make, taxes, business rates, or those paid by the tenants? So tenants will pay. So I know we're probably going back quite a lot into the presentation now. Green. Business rates will be paid by the tenant if a tenant's in. Taxes, I assume you talk about landlord paying taxes on the income. For sure, landlord's going to be paying taxes on the income from it. Business will be paying its own taxes. But pretty much when a tenant's in, they're going to be paying for everything. They're going to be paying for the utilities. They're going to be paying for the business rates. They're going to be looking after that property, dependent, of course, on what the terms of the lease say. Regarding commercial, can be used for anything. Sorry, this is where Neil was having a conversation. Yes, Neil's absolutely right. You can't just take commercial and do anything with it. There's different subclasses of commercial. So I won't go into it all now because it'd be a bit dry for this sort of presentation. But if you Google sort of commercial planning classes, yes, you have to have certain commercial planning for different things. You couldn't just take a cafe and turn it into a fish and chip shop. There we go. Oh, right. Flew under the radar. Fine. Lovely. Rob, let's put this on. I bought a building, commercial on ground floor, and we'll convert up floors to resi. Lovely job, Neely. I've just done a deal with Greg's Bakery to release the ground floor. I'm going to put that on. That is a definite hand clap. Amazing. That is awesome. Greg's. You're not going to go wrong with Greg's, are you? I mean, they're probably going to be as recession-proof as you can get as a tenant. So that's a fantastic deal. I'd love to know what terms you got on it, Neely. How long? Are you happy with the rent? What sort of fit out they're doing? I think that's fantastic. I would very, very happily take Greg's as a tenant because I think they're pretty recession proof, if I'm honest. Love it. Love it. Interest rates, yeah, Neely's saying the same. Interest rates rising immediately affected commercial property and it's working its way through residential price. All things as a house price should perform more before the bottom. I agree, Neely. Totally agree. Lovely. Neely, stashed your cash. The bottom hasn't come yet. You don't see double-digit yields. It depends where you're investing, Neely. Sorry, I know. Sorry, I'm going through all of these one by one. Where we are, we're definitely seeing double digits. Just to give you, let's just work out a yield on this quickly, Neely. Right on this one. This is not a. I've got a better thing than you do, Neely, with your commercial development. I'm just quite interested to actually try and work this out. So let's just go back over here. So let's just work out on this particular one. So we bought this for 345. I know because we're just about coming to the end of the works we're doing. We're going to be in, including buying costs, at about 395 for the whole building. That's white box down here, and one flat fully refurbished. The other 3 flats are occupied in various states of repair. They're all fine. Let's just say we split that by 3 to get the floor plate from the 3 floors. So the commercial down the bottom is 400 divided by 3. Let's go 120 because it's probably slightly bigger. So let's go 150, right? Because it's got an extension at the back, this thing. So let's go 150 value out of the 395. And we've just got it agreed at 25k, which is 20% gross yield on that particular unit, which we're pretty happy with. Greg's rent is 42k per year for 10 years, and they are spending. Oh, that is a beautiful thing. Fantastic, love it. We could be talking about this all night. Right, what I'm going to do, team, is I'm going to end it there. I'm going to go. If you want to take advantage of. Let me just get rid of Neil's comment there. Of property data, fantastic. Use that link. Property filter, don't use that link. There's another link in the description. I'll put it in the pinned comments. Feel free to do that. If you're still watching on the live or on the replay and you're looking at getting into this from scratch, I recommend you download the white paper, which is free, PDF. Take you about 30 minutes to read it. robstewartglobal.com/white-paper. That will give you sort of a bit more of an overview of this and the strategies that I believe are working very well right now. But it's been a pleasure. Hope that was interesting, something a little bit different. Next week, we'll be diving into Nationwide's HPI and probably by the end of the week, Halifax's HPI. So back to crunching some numbers and looking at some market data for the residential side of things. But otherwise, have a great evening. End to the week and a great weekend. And I'll see you very soon.